I am creating a retirement income fund as I transition into retirement. This fund will be distinct from my risk portfolio, about which I typically write, as the other type of risk investments tend to be more interested than boring, income investments. As I began to plan out my approach, I sought out some of my favorite writers on Seeking Alpha to identify their recommendations for retirement income. These authors include Colorado Wealth, ex-retiring with higher yields, Mr. Dirk Leach, If I Had to Build an Income Portfolio Today, Last Update, and Mr. Brad Thomas, among others. After reading across a number of authors, however, I found myself still not feeling very confident about simply moving ahead with what is being recommended today, given my concerns enumerated below. While I will be employing some of their ideas as specific investments, I am electing to go in a different general direction. Because of this, I did not plan to write articles on this effort, as it originally looked to be somewhat mundane. I am now choosing to write a series of articles based upon what I have learned, to provide an alternative path for those savers who are seeking income while attempting to minimize long-term capital impairment. My purpose in writing this article is not an attempt to seduce retirees into blindly following my specific investment advice or selections, and I pray they not do so. Rather, my hope for this article and the two following in this series is to prompt a moment of reflection for retirees and other savers, who I refer to as savers in this article, highly dependent on capital preservation, to ensure that they continue to invest in those investments best suited for them. As I learned, as I began to select what to include in this fund, I believe that we are transitioning to a new investing environment. I believe these changes in investment landscape may not yet be widely recognized, and that many portfolios may be on autopilot. I believe that this combination can be a dangerous mix and raise this as a concern. That is why I am writing this series of articles. Brief description of my retirement income fund, to provide perspective upon those factors that the author believes critical to investing success going forward. One needs to have a brief description of what my income fund will look like and how it is intended to be managed. The nature of the fund can have a significant impact upon what factors are actually critical. For example, an active trader would view different elements critical than a long-term, buy-and-hold investor. I am creating a retirement income fund, that is designed specifically to derive the income exclusively from interest and dividends from investments, rather than a partial reliance on capital appreciation, B, with an intent to use a buy-and-hold forever, designed to minimize transaction costs, taxes, and other inefficiencies created by turnover, which also C, allows it to be ignored for extended periods, as I have better things to do than check my income fund every day, or week or month. That B delivers a 6 to 7% yield currently and will maintain the current spread over short-term rates. In short, I want to generate 6 to 7% yield on investments that are stable, avoiding capital impairment over the very long run, and don't need to be managed often, creating essentially a buy-and-hold forever portfolio. At first blush, this does not look like to be too great a task. However, as I began creating this fund and have considered the current environment, I have learned that it will be a more difficult one than I recognized at the beginning of this effort, and have elected to share my observations with the Seeking Alpha reader. Factors critical to the creation of an income fund at this time. There are several factors which I believe will significantly impact income funds over the next 10 years that are vastly different than what we experienced over the last 10 years. We are investing at or very close to interest rate lows. This factor, and the next, references a significant amount of material from an article published nearly a year ago, Fixed Income Investing, July 8, 2016 Changed Everything, published on August 21, 2017. The conclusions in that article appear to have been confirmed by what has transpired in the past 10 months since the publication of that article. If one looks at historical short rates, one can get a long perspective, looking at Find Bank of England rates back to 1694, i.e., back 324 years. Source: Fixed Income Investing, July 8, 2016. Changed everything, referenced above, and Bank of England website, superimposing more recent Federal Reserve data, starting in 1955, to compare U.S. and BO rates. One gets the following data from Bank of England and Street. This Federal Reserve website taken from the referenced article above. One finds that both set of rates are at low points going back through their respective histories. That is, we are at the low point in short-term rates since 1694 for BO and back to 1955, the earliest point that I could document on the site. I suggested this to a CPA associate of mine, who scoffed at me and blasted me for my careless comment based upon the work above. He suggested that these were the low rates not merely since 1694 but arguably since the dawn of mankind. His view, admirably argued, was that these are the lowest rates since the Egyptians fought the Hittites at the Battle of Kadesh in 1274 BC or since the Code of Hammurabi was developed in 1750 BC. Whether you use his view or mine, current interest is at one end of the interest rate distribution for the past 300 years, and arguably, much longer than that. While an 8-year of 30-year rates which occurred recently on July 8, 2016, at 2.11%, did not quite decline to the lowest rate reported in 1946 of 2.09%, but is close enough to be considered as matching those previous lows. That is the starting point for development of the subject fund, which impacts how this money should be invested. Takeaway: savers need to realize that we are investing at a period of historically low interest rates and that these low interest rates have propelled valuations of debt and equity securities to very high levels. B. We have moved past the lows in interest rates, therefore moving into a secular period of rising interest rates. Barry Ritholtz published in 2012 a classic blog consisting solely of this view of interest rate cycles over history. Original blog found here. He indicated that he loved these long-term charts like this one as they extend over a very long time, as do I. I am sure that it is known to Seeking Alpha readers that interest rates cycle over decades. However, this graph demonstrates this long-term movement of rates. Since 1900, we have experienced these cycles: 1900 to 1920, secular increases of 20 years; 1920 to 1946, secular decreases of 26 years; 1946 to 1981, secular increases of 35 years; 1981 to 2016, secular decreases of 35 years, assuming the author's endpoint for this cycle is correct, as discussed below. 2016, to be determined. Looking at more recent data from the past 5 years, June 24, 2013, to June 21, 2018, we get a more granular view of interest rate movement for 30-year maturity Treasury securities. Data from Street Lewis Federal Reserve website. One can see two downward spikes in rates. The first occurred on January 30 and again on February 2, 2015, reaching a lowest close of 2.25%. The second occurred on July 8, 2016, at which point the low since 1946 of 2.11% was reached. On the close, intraday could have been lower. So, one can see from the chart, an inverted double top at 2.25% and then at 2.11%, an immediate retracement higher from the second low, several tests to return lower, over the next year only being able to retrace about a third of the distance back to the second low, and movement back above the 3% level, with the former overhead resistance level now representing the floor at 3%. As I argued in the earlier article, this looks to me like a floor of 2.11% is in for this cycle, based upon a interest rate low of 2.11%, matching a comparable low in the last cycle ending in 1946 of 2.09%. The repeated attempts to reach the old lows after the July low, which have failed several times, specifically, able to retrace only about 50% of the 1.08% increase from the low to the high point. 3.19% reached on December 16, 2016, back down to 2.70% on June 26, 2.67% on September 28 and 2.17% on December 16, 2017, with the downward movements failing at these points each time. Movement of interest rates back above, and remaining above, the 3% level representing a new floor. From this, how does one know that the 3-decade-plus bull market in bonds is over? One doesn't know, but if you wait until you know for certain, one will have lost an early mover advantage in reacting to this secular change. You will only know the answer as an absolute certainty when it is too late to benefit. In my opinion, there is a high probability, but not certainty, that the period of secular interest rate declines that began in 1981 ended on July 2016. The probability is more than high enough to create a basis for me to act and invest. Combining the two factors described so far, we start with historically high relative valuation for both bonds and most equities, driven to these very high levels by historically low interest rates, which has driven up the value of debt and equity investments to sky-high levels where the basis of the valuation is grounded on these historically low rates, where the extended period of these historically high rates appears to have come to an end nearly 2 years ago, suggesting, in turn, that rates have already begun to rise, resulting in downward pressure on the valuations of both debt and equity securities, and with a ever-broadening recognition of a turn in rates upward resulting in anticipation of future declining rates pressing valuations down even more. Given that the market is an anticipating mechanism takeaway, savers should consider the substantial evidence that the best days of the great bond bull market are over and that they may be moving into a secular period of rising rates that history would suggest will last decades. C. Default risk versus maturity, duration, interest rate risk. There are at least two key risks present whenever fixed-income investors purchase securities. 1. That the borrower will fail to repay all or some of the amounts borrowed, resulting in substantial or total loss for the creditor, default risk. And 2. For long-term borrowings, that interest rates will increase, reducing the value of the instrument, now offering a below-market return. This results in a suppression of the market value of the security towards the point where the new lower market price of the instrument now offers a market yield. Given that default risk tends to create large market losses while interest rate risk tends to result in much smaller, more incremental losses in any given moment, the small probability of the default risk is often offset by the disproportionately large consequences of that event. As a consequence, this fear can have a market price impact well in excess of the probability of this event. Ordinarily, the fixed income strategy for retirees and other savers where capital impairment must be avoided is simply to load up on bonds from a number of quality issues and clip coupons going forward. This obvious strategy has worked for a vast number of retirees over decades. However, as we will discuss in later articles, the use of this strategy may be unwise at this point in the interest rate cycle. Starting at this point where the only way to go, over the long run, not over the next few months, is up in rates and down in valuations, loading up on long-term bonds looks unwise, regardless of the quality of the security. With a long-term prospect of a secular rise in interest rates as probable, the result will be an equally long-term period of pressure in income investors as the value of their securities will be ground down over the next 30 years. Consider how you will feel about the yield from a 30-year, 3% bond in 10 years, if rates rise to 7.5%, roughly midway between the high and low of the last cycle. You will have a fixed income investment offering a pathetic yield, whose market value will have been cut nominally in half. Takeaway: savers need to ask themselves whether they want to accept more default risk to offset the cyclically high risk associated with historically low interest rates in place today. D. Does it pay to buy longer maturity debt? Here is a table with 2, 5, 10, and 30-year U.S. Treasury yields. Moving out in maturity has been a classic strategy over decades to enhance yield on fixed income. Indeed, this is also true at this time. However, it is worth noting how much extra income one obtains for substantial extension of maturity. At this time, one gets a vanishingly small additional yield for substantial increases in maturity. Key observations drawn from the table above: A. 2 to 10 spread is 35 bits per second. B. 2 to 30 spread is 49 bits per second. C. 10 to 30 spread is 14 bits per second. That is right, 14 bits per second. So you are putting your fixed income investments at risk for an incremental 20 years, significant in the life of a retiree, for a measly 0.15%. Takeaway: savers need to ask themselves if they truly intend to put at risk the capital earned over a lifetime to get an extra 15 bits per second. E. Bond Kings have recommended bonds. Is this advice appropriate for you? On April 2nd, Mr. Nicholas Cheer wrote the following article with a title that got my attention: "The 30-year Treasury is the cheapest asset class on the planet." You could infer from my writing above that I have a slightly different opinion than both Mr. Cheer and Citigroup, NYSE, who was cited in the referenced article as having a similar opinion about the valuation of long-term debt. But should fixed income investors take Mr. Cheer's advice and load up on safe, undervalued, 30-year debt? Should you ignore my points and follow Mr. Cheer and Citigroup? In fact, I thought that Mr. Cheer's article was very thoughtful and very well written. This may surprise some, but it was quite well thought out. However, reading his article raises the critical point that is needed: for whom is this advice given? If you read Mr. Cheer's article, he is focused on shorter-term, 2018 and 2019, investment results based upon total return, discussing immediate trends over the next few months and value relative to European debt, for example. In fact, if you read the work of Mr. Grundlach and Mr. Gross, they are also focused, generally, on total return and shorter-term results. With everyone recommending bonds, they must be good for retirees as well, right? Consider this point made in Seth Klarman's Margin of Safety, as reported in an article on the Value Walk website. For still another example of speculation on Wall Street, consider the U.S. government bond market, in which traders buy and sell billions of dollars worth of 30-year U.S. Treasury bonds every day. Even long-term investors seldom hold 30-year government bonds to maturity. According to Albert Boynalower, the average holding period of U.S. Treasury bonds with maturities of 10 years or more is only 20 days. However, most savers would think about income yield when considering purchases of debt, not necessarily total return. So someone may hear a recommendation about buying long-term debt, hearing that it is undervalued and therefore believing that it will provide good income, when much of the value of the recommendation is for capital appreciation for investors with very different aspirations in very different circumstances. This is reinforced by the observation that Treasury bonds were held for 20 days in the late 1980s, when this was quoted, and may even be shorter today. That does not suggest a safe, prudent investment but rather a speculative trading vehicle. That also implies that many investors in long maturity treasuries are far different than a retiree seeking income. Savers specifically, and investors generally, should pay equal attention to the recommendation as well as for whom the advice is intended. Savers will not be buying and selling 30-year debt every 20 days nor day trading 30-year treasuries to secure a 25 BP capital gain in 4 hours. Rather, they are going to be buying long-term debt to provide income from the coupon for a long period of time, if not through to maturity. Savers should make sure that the advice taken is the advice intended for them as an income investor. I follow Mr. Grundlach and Mr. Gross very closely, as they have a great handle on bond values and wonderful insight into the fixed income world. I found Mr. Cheer's article to be thoughtful and well-written, making many solid points about fixed income, even if I disagree with his conclusions given my arguments here. However, I also understand that, from the point of view of building a retirement income portfolio, that their advice about trading sovereign debt may not be for me nor for other savers. I don't view their advice to be wrong at all, as all are inspired investors. Rather, I simply view that advice as being offered to someone for whom it is not appropriate, from the perspective of creating a retirement income fund. Takeaway: savers should be sure to look at the aspirations of the individual offering advice to ensure that it matches their own, to ensure that it is advice appropriate for them. F. Did you forget about QE? From a base of $925 billion in the Federal Reserve balance sheet, successive rounds of quantitative easing, QE, drove up the holdings in the Fed balance sheet to nearly $4.5 trillion over the past decade, a breathtaking increase of over $3.5 trillion. Over the past year, the Federal Reserve had indicated reductions of $90 billion a quarter, and the balance sheet has dropped to about $4.2 trillion. The Fed has further indicated that they plan to increase the rate of asset reduction on the balance sheet, from the previous $90 billion a quarter to $120 billion a quarter. This is generated not by sales, but buying fewer bonds to replace the bonds that are maturing in their portfolio. As such, this reduction does not result in the Fed forcing new supply on the market. Rather, the reduction is effected by simply failing to buy as much as maturing, requiring other market participants to pick up the buying slack going forward. I have no doubt that the Fed will execute this flawlessly, as this section will not be a critique of the Fed's ability to run money operations. The Federal Reserve has been a bit cagey about exactly how much of the QE asset holdings will be reduced over time and what the balance sheet asset target is. They have hinted that there will not be a return to the $1 trillion level in place as the program started. Other hints have suggested at a number in the range of $2.5 trillion, with other numbers also floated. For the sake of argument, I will use as a premise that the Fed intends to reduce their balance sheet from $4.2 trillion to $2.5 trillion to make a point. Using $2.5 trillion as a target, that would result in future decreases of $1.7 trillion, reductions needed, starting at $4.2 trillion. So, $1.7 trillion or $1,700 billion of future asset reductions effected at a rate of $120 billion per quarter would imply continued assets reductions continuing for another 14 quarters or more than 3 years. So while the impact at any time may not be that great, there will be a gentle but persistent force pushing rates up. Less buying results in greater supply for the remaining buyers, arguably pushing long-term rates higher over an extended period. What will be the cumulative impact of this continuous unwinding of the great QE experiment over years? So there will be an additional force persistently pushing up long-term rates over the next 3 to 4 years. I am expecting the Federal Reserve to execute the program effectively, but regardless of how carefully this is done, $1.7 trillion of long-term debt placed into the market now with a more narrow group of borrowers will, all other things being equal, press long-term rates up. Takeaway: savers need to understand that there will be structural forces beyond the typical market forces where the not-so-invisible hand of the Federal Reserve will be pressing long-term rates higher. Summary and conclusions: this article has argued that the great bond bull market of the last 35 years has ended, and we are migrating into an equally extended period of higher interest rates, if history provides any reasonable guide. Whether interest rates will increase quickly or not, how long will rates increase, when will this period end, and what the terminal interest rate will be at the bottom of the upcoming bond bear market are all unknowns. I am not arguing for some dramatic crash nor suggest that investors dump their positions, buy canned goods and head for the hills. Indeed, we appear to be 2 years past the end of the bond bear market, yet it is hardly noticeable and is seemingly unrecognized to this point. It could even be that rates will suddenly turn around and head lower, challenging the old lows, even if I would argue that they will be unlikely to breach the old lows. However, it is important to point out that most investors working today have developed and reinforced their ability to invest in arguably the greatest bond bull market in history. Starting from the highest rate ever, as shown on the Ritholtz chart above, rates have declined relatively quickly to match the lowest rates on that chart. We have traversed a path from the highest to the lowest historical rates in 35 years, with most of that taking place in the 25 years prior to 2008. Even as investors may have survived the vicious counter-trend interest rate increases in both the early and late 1990s, for example, it did not take long for the rates to recover and re-establish their downward trajectory. Even mistakes could be bailed out if one waited long enough. I believe that what worked well in the past will not be working in the future, with savers and investors needing to adapt strategies and tactics for a new investing landscape. I have argued above that the golden days are over and a new set of approaches will be needed as rates begin to rise. These rate increases will pressure valuations of those investments that would typically be automatically added to retirement portfolios, investment-grade bonds, municipal bonds having long duration, high-quality equities which are bond proxies, like utilities, telecoms, rights and consumer staples. Other replacements for these typical selections will be needed, at least for a significant part of the portfolio. We will discuss investment class selections in the 2 articles following this one. Please note that I did not say panic, crash, disaster, dump and do stupid things. I am only suggesting that investors, especially retirees and other savers particularly sensitive to capital impairment, should pressure test their portfolios to ensure that what they own will hold up if interest rates begin to head higher. Here is what I am saying, which is the final takeaway: savers need to prepare themselves for when these rate increases come. Disclaimer: no guarantees or representations are made. The OWL is not a registered investment advisor and does not provide specific investment advice. The information is for informational purposes only. You should always consult an investment advisor. Disclosure: we are long BRP, EVF, JQC, ISD, WIA. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.